again, thank you for everybody that is here. We appreciate it. But let's get started. Hopefully you can see the slides. I'm pretty sure you can. We're just going to go over these and then have maybe have a Q&A. At the end, I might have to unmute you guys that do have some questions. Usually in a webinar, you just put it in the Q&A, but I do not see that here where it's normally at. And I've done hundreds of these webinars, types of webinars before. So kind of what we want to do today is just go over some tax breaks that happened in the Big Beautiful Bill, how it impacts you, and what you can do about it. Okay. So this is the big one right out of the gate, in my opinion, for most businesses. This applies to everybody that is listening. Okay, and that's 100% bonus depreciation. It is back. It was sunsetting. It came in the first tax bill that was passed in about 2018, and then from 2022, it started sunsetting. So it'd go down 20% until it was going to go away. And be zero, okay? But it was reinstated in this new Big Beautiful Bill. And what was great about it is that you don't have to have profit in the business in order to take this one. And so it could increase your loss in your business, which would decrease your overall taxable income, which is what we want to do, right? So this allows us to take depreciation, which depreciation, if you don't know, just means expensed over time. That's it. It could be 5 years, 7 years, 15 years. But this is something that will allow you to take that full amount in the first year. So this one's big, you know. And so definitely utilize it, right? So an example, you buy 200K in equipment, you can deduct a full 200K versus depreciating it, like I just mentioned. Okay. And that brings down your taxable income, means you get to keep more cash, and that is good for everybody. The point is we don't want more money go to the IRS than what needs to be. But it is the IRS's job to keep their money, right? To keep what they think is their money. And so documentation is key, by the way, just as an aside. You know, make sure you're keeping your receipts and your invoices and all of the above. Very, very important in business. So now, you know, we're usually just saying no to receipts, right? Now we need to get into the habit of saying yes to receipts for pretty much everything, just so we have those things. Section 179 is a lot like bonus in a way, but this one, it's kind of capped at the profit that you do have in the business. So this won't increase a loss, but it is a huge deduction as well. It has increased to 2.45 million, excuse me, from 1 million in the Big Beautiful Bill. But it does have a lot of the same effect with machinery and, you know, all those things that's listed there, right? You can take a much bigger level of depreciation in that first year. With bonus depreciation being 100%, Section 179 actually gets forgotten about a lot because you take 100% from bonus and you're done. So 179 is not something that we even started looking at until bonus depreciation started going down to 80, 60, you know, and 40. Now it's back to 100%. So you might not hear a lot about 179, but it's always good just to kind of remember that and say in the back of your head to say, wait a second, what about this? Can we leverage that as well? With bonus there, it's probably not going to be a thing. But as it says, it is flexible. You can combine it with bonus if bonus wasn't 100%. So example, you spend 2.4 million on qualifying assets that you can fully depreciate, you know. There are always assets to, got to put this out there, like vehicles that are always based off of business use though. So you got to use, you're going to get the deduction based off of how much you're using that vehicle in your business. So it might not be fully deductible. Could be if you're using 100% for business. Okay. So QBI, this is another big one. This is one that is pretty much going to affect everybody that's listening. QBI deduction, and it was made permanent, which is awesome. That was going to go away this year as well, which might be on here somewhere. But there you go. Eliminate sunset date, originally set to expire this year. But you get a 20% deduction on qualifying business income, right? So really your profit in your business. And that gets taken off of your federal income tax or your taxable income on your personal return. So that is a very, very big deduction that applies. And the reason why this came about is, you know, C corporations, they're taxed at 21% on profit in the business. And so it really wasn't fair for people who are LLCs, let's say, to not get some sort of a deduction as well. And so that's where this came about. I'm glad to see it here. It's too bad there was a rumor that was going to be 23%, but it ultimately landed at 20%, which is what it was before. Minimum benefit, if you have $1,000 of QBI that you can take, the floor is $400, which is pretty cool as well. Get a little bit more, get a 40% deduction on that 1,000 that you could take. You know, and again, if you have any questions, you know, at the end, I'll try to answer it the best I can. But you know, that QBI affects your overall taxable income on your personal return, right? So if you guys have great W-2s, it's going to decrease the taxable income, let's say, from that W-2. And so you can keep more money in your pocket. So you can kind of see here an example, 20K profit, 40K deduction, lowering taxable income to 160. Very simplified example, but that does prove the point. So far, right, everybody, as just going back just a little bit, bonus depreciation and QBI, those are the big things right now for businesses. They apply to all businesses pretty much. So those are the ones. We'll get into some other ones here that may not apply to you. But still, again, we put it in the back of our minds to where it's like, oh, wait, I'm going to start doing this over here. Maybe that applies to me. And then we can have that conversation. Which, like this one, R&D expensing credits. This has been around for a while as well. And it's great, but it really is set up for people who are, a lot of software companies will use it. Or even, you know, that small business that I worked in was a dental office. And it can apply to dental office as well, because what happens if they decide to come up with a better way to whiten your teeth, right? And that happens quite a bit. And so they start doing that R&D, research and development, and they could get a deduction for it. Now, a lot of times the deduction is on the payroll tax because you're hiring somebody to do that work. Think software engineers and people like that. But certainly, you know, if you are into that type of thing, you're an inventor, right? Then we want to look into this so that we can do it the right way. I believe one of our partners that we do have, Gusto, they do the R&D work because it is again, Gusto is a payroll company, but the credit is tied to payroll. And so I believe that they do have that service. I read somewhere that they have an R&D type of service, because it does take a lot of work to get this credit. It's just not like, it's not like bonus depreciation or even, that QBI that happens pretty much just automatically on your tax return. This is something where you have to have crunching numbers and stuff like that. So you're paying somebody to do this credit, really. And it's easy to get on the tax return, but the work is where you're paying somebody to do it. So again, this one probably doesn't apply to a lot of you guys, but keep it in the back of your mind. It could come in handy later on as your business grows, and so forth. Okay. So an example, 10K in R&D credit and immediate deduction, plus 10K or 20K in credits. So it can be a very big credit for sure, right? And that's why people will pay to have it done, because it can be a very big credit and deduction. Okay. So you can see here the benefit is it encourages investment in innovation, product development, and hiring people. And that's one thing that the government does love, is having companies provide jobs to other people, right? That's why you'll hear Facebook and Tesla and all those things. When they move into an area, they get all these tax breaks, most likely on the land, the property tax, because they're bringing in 5,000 jobs, 10,000 jobs into the economy. And the government likes people working because they can collect more taxes on us. That's why they like. That's what I'm saying. Maybe they just don't, I don't know. Maybe I'm jaded more than some people about the government, but I think they just want more taxpayers. How's that? I'm fine paying my taxes. I'm just throwing that out there now. Kind of. I don't know. I just want to pay the smallest amount I can. Child care credit. I'm just making myself laugh here, guys. I'm good. Child care credit was boosted. So this is, again, right? They're giving us a lot of good credits here, 600K in annual credits, because we're hiring people. They love us hiring people. So again, most of the people, and there's nothing wrong with this, by the way, right? You guys might not ever hire an employee. And there's nothing wrong with that. Don't think that you need to. You can make a great business just by yourself. You do not need employees in your business. Now, there could be a time where you would, and that's great too. But a lot of people think, I got to grow, I got to hire somebody, things like that. And it's like, no, perfect your process. If you're new, perfect the process. Make sure your delivery is good if you have a product or service. And then let's see if we can't take it to the next level, right? So don't get over your skis by hiring somebody that you really don't need yet, okay? But it is a huge benefit. Spend 80K on employee childcare, $600K credit, right? Huge. So, and benefit, increase employee retention, right? Supports workforce participation. Now, the tax guy in me has to bring this up. If you don't use the money that you get from the child care, because sometimes they'll reimburse you on a W-2, not reimburse you, but they'll give you a credit for child care. It shows up on box 10 of the W-2. And you don't use it for child care, they do tax you on that money, just so you know. So that's the tax accountant in me throwing some tax stuff at you. Refundable child tax credit increase. This isn't directly related to business, but it is there. I'm trying to remember off the top of my head what it is. It might be on the second page, but this one escapes me a little bit. But this is usually triggered for, especially the refundable credit is usually triggered for people who are more lower income, things like that. But most people do get a child tax credit if you have children, and it's great as well. Because what's so nice about a credit, as opposed to a deduction, is a credit decreases your taxes dollar for dollar, right? So if you had, if you paid $4,000 in taxes, but you had a child tax credit of $2,000, it's going to bring down that taxable income, $2,000, or not taxable income, I'm sorry, the taxes, the $4,000 tax, $2,000. So that's pretty cool. Refundable credit just means that if this applies to you, you don't have to have any taxable taxes. You'll still get that credit. So it's cash money coming back to you. Where a non-refundable credit, it will only bring down your taxes to zero and then it stops. Where a refundable, it might already be zero, and now you get a $1,000 check because it's refundable. So elder tax credit, I think this one was just thrown in here, but this was for that. You probably remember they were talking about no tax on tips or overtime, trying to get rid of taxes on Social Security. Well, the Social Security thing didn't happen, but what they did do as kind of a stopgap was to up your the retirees' tax liability. Okay, and that would then bring down your taxable income. So, and hopefully just wipe out any taxes that Social Security would have created. So that's the hope there. And I think it will apply to a lot of people that where their Social Security isn't huge. And so this is good. This is good stuff. Hopefully we can get to the point where Social Security isn't taxed at all. It doesn't even show up on the tax return anymore, but we're not there yet. Okay. So what does this mean to you? I'm going through these slides fast. So new equipment purchases, 100% deductible with that bonus depreciation or Section 179. You can get retroactive R&D. So if you've done R&D, let's talk about that and see if we can't get a credit for that. Now, one thing that I've dealt with in the past was some people think that they can do the R&D credit, but they're just paying other people to do it, like they're paying a separate company to do it, and that's not going to fly. It's you doing it in your business and hiring people in your business to do it, not just hiring a separate company to do it. Okay. QBI permanence, long-term tax planning, right? It's great. QBI is just, it's icing on the cake, really. It's going to lower your taxable income that 2% or 20%, which is great. Opportunity zone, we didn't really talk about, but we left it in here. Again, just to spark that mind. There are some things like real estate people get into this higher than most. And so usually these are in neighborhoods where they're trying to spur growth. Okay. It's not for every section of, say, I'm in Utah, so Salt Lake. There could be only some sections in Salt Lake that would qualify for opportunity zone investment. Okay, but this usually does apply for real estate mostly. but it also can apply to businesses that would establish a business in those opportunity zones as well. QSBS, we also didn't talk about this one. This is something for people who are companies that their whole goal is to build something and then sell it, right? And the advantages of this is that there is a certain amount that is not taxable. And if you're going to do this, if this is your goal, if anybody's listening in here, then a C corporation is where you need to be in order to do that. And I'll just leave it there again. But if you're wanting to do this, it's a qualified small business deduction. And it is something that most software companies get into. Like that's what they set in to do, is to build a software and then sell it. And if that is what you're trying to do in your business, then this would be something that you would want to start out of the gate as a C corporation, because usually you can't just move over once you have an established business. So again, I would say do your due diligence on that one. If you're interested in that, do some of your own research and stuff like that. Because that one, I would say that is that's the ultimate gamify, let's say, of a business. You know, that's the next level up. That's accounting or business 201, 301 type of stuff, not what we want to do, which is that 101 type of starting out and what we're doing here with this webinar. But again, still good to know in the back of your head. And then finally, child credits. If you're hiring people and you're providing them with childcare, right, then you could get a credit for that. Okay. So what does all this do? It's going to reduce your taxable income, which is what everybody wants. Keep your cash, and then increase the cash flow. It also just allows you to plan more, right? That bonus depreciation. When do I want to buy that equipment? Do I want to buy it at the end of this year, 2025, or do I want to wait till 2026? Which is why doing your bookkeeping is so important. If you're new, you know, don't sleep on bookkeeping. It's got to get done. You can't do your tax return without it. And it allows you to plan for some of these things and say, I'm going to have quite a bit of profit this year. Maybe I'll buy that piece of equipment that I was thinking about buying in 2025. Or, hey, my profit looks pretty good. I'll delay until 2026 because and worry about the profit next year. Worry about that. Get that deduction next year. My profit will be lower next year, or maybe it'll be higher because that piece of equipment is going to help you scale up in your business and earn more income, which is hopefully what it does. That's why we spend money in our business, is to make more money. We spend $1 in our business to make $5, $10 in our business. Okay. All right. So how can we help? Proactive tax planning? That is a real big focus this year that we want to do. And this does apply to the Plus plan. I'm just throwing that out there. The starter plan, we can help on how we can, but tax planning is really for those people that they got money coming in, they need that planning. And so that is a focus that we are doing. If you are on the Plus plan, definitely get an appointment with your tax accountant to do some tax planning. We're almost at the end of the year. Let's not wait. Once the year is over, it's very, very hard to, well, it's basically over at that point. You can't buy a piece of equipment. You can't do these things. There are some things you can do, but for the most part, it's over. We're stuck with what we've got. So I think we've talked about a lot of this stuff, right? These are the things that we can help with, right? And so make sure that if you do have questions, get that appointment. It's very, very important. We want people to be engaged with us, and we want to engage with you, right? Another big push that we're doing is just scheduling an appointment before we even get off the phone call with you that we're already on, right? We want to book those meetings in advance so that we can do these things. We can see that, yes, this will apply to you. So let's start early and make sure that we are getting all the steps and making sure all of our ducks are in a row so that we can maximize your tax savings. Yeah, we're always looking at ongoing. We're always, well, I do. When I go home, this is what I do when I go home. I get onto YouTube and I see if there's anything going on that I need to be aware of, and always trying to learn. So is there any IRS regulations that came out? What can I learn? What can I bring back to my members to make sure that they are informed, right? And then we talk about it as a group here. And then a lot of times you'll get something in your email that talks about, hey, this is what's going on. This is what you need to be aware of. A lot of you guys, if you've been in business for a while, you probably heard of that BOI. We sent a ton of stuff about that. That's not a thing anymore because it's just not being enforced. It's still on the books, though. I brought that up. I don't know why I brought that up, but it is still on the books. It's just not something that this current administration cares about. 2028, if there's a new administration comes in that does care about it, then we're going to let you know. All right. So things that you need to be aware of in Q4. Let's see if I jumped again. Finalize your 2025 bookkeeping. Like I talked about, if you are behind on the bookkeeping, let's get caught up, right? Bookkeeping is the most important thing you do during the year, in my opinion. We cannot do your tax return without it. So get caught up on your bookkeeping if you're behind. I know it's annoying. We ask for things, but we got to have them. Okay. Schedule tax consultation at Q4. Let's do some tax planning. Yeah, start organizing your documents, right? What W-2s did you have this year? What tax documents should you be looking out for in this next coming year, right? So that you can be ready. We can get the tax return done when you want, right? And that takes planning a lot of times. Make sure that you have everything. So I would start a list. Say, I've got 3 W-2s, I've got these K-1s, whatever it is. Start writing them down so that you can be organized and we know that everything's been uploaded. Okay. Make sure that your personal information is updated. That's done through our tax checklist. We want to make sure that the address is very important. If any government agency or the IRS is trying to reach out to you for whatever reason, we want the most up-to-date address so that they can reach you. Okay. Upload documents, right, through the dashboard. Very, very important. We want to see them. That prior year tax return that a lot of times it comes out when you first sign up. That is very important. We can match names, make sure the names are correct. We can look for carryovers. Again, talking about making sure that we have captured all deductions. Those are usually on your prior year return if there's any carryovers, and we can get those entered in. So you can take them in the new year or in the new tax year. So that personal business or the personal tax return is very, very important. Yeah, you can ask about any law changes that happen that may affect you, and just reach out for questions. Stay engaged during the year. I think I'll just lead with or kind of end with this. I think for the most part we're wrapping up here, but we want to make sure that I lost my train of thought. we want to make sure that, we have everything that we need. We want to make sure, and you want to have a level of confidence that everything has been uploaded. But I lost my train of thought. I was going to say something. I'm sure it was profound or boring or both. I don't know. So there's a VIDE roadmap. It kind of just says what we want you to do during the year. It's very, like if you're doing this, then you're going to have a very successful tax season. Oh, what I was going to say is, like, people these days, we are very, we get things very, very fast, right? I can get on my phone and get a question answered very, very fast. I can log into Netflix and start watching shows right away. Bookkeeping and tax work is not that. It just isn't. And so we have this roadmap here that shows the process, but this process lasts. If you signed up in January, right, your tax return's not due until April 15th or maybe March 15th, depending on which tax returns you're filing. That's a long process, right? But it's very, very important. And these are IRS rules, not our rules, right? If we could send in a tax return as soon as we could, we would do it and get it over with. But this is what we have to work with. And so the process is what you're doing during the year. We're making sure that things are uploaded that the bookkeeper needs, that your guide needs. You're reviewing your books monthly, right? To make sure everything is categorized correctly. You're paying your estimated tax payments if you have profit in the business, so that you don't have this big amount of money that you need to pay come April 15th. You're meeting with your bookkeeper and your team, your tax accountant, quarterly, right? So that we can recommend things for you to do, And then I understand some people are very hands-off. And they're just like, yeah, just, here's my bookkeeping, get the bookkeeping done, do my tax return, I'm good. There's nothing wrong with that. But so you do what you feel needs to happen, right? And we're going to still try to reach out to you, though, in that quarterly cadence to make sure that you're taken care of as well. Okay. So I think we've gone through a bunch of this. We can keep going. I've talked about it a lot. So I believe that is the end of the slide. So thank you so much for joining. I will take questions the best I can. Like I said, I don't see the Q&A in here. It's not underneath here. I don't know if it's hiding somewhere, but I don't see it. So probably what I'll do is we can take some questions for the next about 25 minutes. But I'm probably going to have to unmute you. And so just put in the Q&A because I don't see it unless I'm blind. There's some other people that from VIDE here. I just don't see. I see polls. Q&A could be. Let me make it big just to make sure that, yeah, I don't see it. So that's annoying. All right. So Dinesh has a question. What is your question?
Yeah, I was going to ask if you could dive in a little bit more to this idea of if you one day want to sell your business, S Corp is not the right structure for it and it needs to be a C Corp. That's the first time hearing that. And yeah, I guess, just if you could dive in more to that. And then if we already are an S Corp and have been for, say, a decade, like, what does that mean for us? And what are the implications if you are an S Corp and you end up selling your business? How does that look different than a C Corp selling a business?
Oh, geez. Oh, man. So this is the hard part is how much time do we want to take with that? But basically, with an S Corp and a C Corp, they do work a lot the same. I mean, a lot of the same restrictions are on both. Okay. Um, and see, here's the problem, because it's a hypothetical question here in a lot of ways, because um, it depends on how you're selling the business. Is it a stock
Mm.
transaction? Is it asset transaction? Things like that. There's a lot of stuff into that. Um, and it's probably the best thing to do is if you're, I don't know how close you're probably interested in this, but is it just an interest, or is this something that you're really considering
Well,
doing
not in the
soon,
immediate future, but it's,
but
hey,
at some
10 years
point?
from now,
Yeah.
10 years from now, I probably do want to exit and sell it. It's just, all I've ever heard
Yeah.
about selling a service firm is, all right, they're going to pay you maybe a multiple on top of your gross earnings,
Yeah.
kind of look at your client list, but I never
Yeah.
thought about like the actual
And,
business formation making a difference.
and that's not going to change necessarily with either the multiple and things like that. That won't change. Um, and just on that a little bit here is, if you are getting ready to sell, like whenever that is, you know, you want to look into key man risk. Like if you're
Mm-hmm.
the owner, make sure that you aren't, you're not, they don't look at it and say, well, this business is worthless if you leave, right? So you want to get rid of that key man risk.
Mm-hmm.
And then just
Mm-hmm.
make sure, is there any way that people, companies or that buy businesses love reoccurring or recurring services? So that's where the multiples come in. For an
Sure.
accounting firm, there's not a big multiple, to be honest with you, because it's hard uh, to scale an accounting firm, in my opinion. So when I actually do go look at what's out there, and it might be like 1 point, uh, like it's not even a multiple, or it's just a little bit of a multiple. They're adding a couple hundred grand if it's in the $1 million range or something like that. But it's
Yeah.
not it's not that 10x that software companies get all the
Well,
time.
not and
Things like
that
that.
I'll figure out. It was more just,
Yeah. But
would me being an S corp versus a C corp, would that impact the sale in some way?
no, it wouldn't impact the sale, but that credit, or it's really not even a credit. It's a exclusion of income that you can take, um, is where the C corp comes into. And uh, being honest, I don't have a lot of information on it. I've never gone through that sale before, so I've never seen it.
Mm.
And that is something that usually when you get into that area, you're going to go to somebody that is into an accountant
Mm-hmm.
that does mergers and acquisitions
Mm-hmm.
at that point. So you know, uh, I would say you'd start planning on that, you know, years ahead of
Yeah,
I'm thinking about selling. Let's start talking about how I can exit in the best way possible.
sure.
Yeah,
Okay. All right. Thank you.
no problem. I got Monique.
Yes. Hi, can you hear me?
I can, yeah.
Okay, great. So as usual, this was a great presentation. I missed the first 5 minutes, so I'm curious, is this recording going to be made available to all of us?
Aha. We were having a little meeting before this, and I said, I'll bet you somebody's going to ask about the slides and wanting the slides. And I didn't say anything about the recording, but I've done, I don't know, I do 3 webinars a week,
Yeah.
and yes, we can get it to you. Yes.
Okay. That would be great. You did my onboarding call many moons ago, and I
Did
did
I?
actually refer. Yep, you sure did. And I
Sweet.
did actually refer back to that recording. So I may be one of the few who actually views it.
Nice.
So thank you.
Yeah. One thing that, yeah, I'll get it to you. Let me do this really quick. Let's see. I just want to, well, I don't know. Is anybody from Vide in the background? Monique Whiting, can you write down that name so I can get her the recording? Oh, Danielle is one of us. Danielle.
I just had a question about the depreciation. So
Yep.
if someone had a significant purchase last year, and they were depreciated things last year,
Mm-hmm.
how does that work moving forward? Or can you go back and, revise that past tax return? Are there any benefits you can have from that with these new changes?
No. To my knowledge, that it's not you can't carry back those depreciation things. And and the 100% bonus depreciation actually only applies to things bought in the current year, right? So if you were to go back, because I don't think it was retroactive, I didn't see anything about being retroactive. It was definitely, it does apply to this year though. So anything that you bought this year, you can take. But if you bought it in 2024, it would have the same rules that 2024 had, which I think it was all the way down to 40% at that point. So, no. So Juan has a question.
Yes, my biggest question is about recapture. Like
Uh-huh.
if I buy a vehicle this year and
Yep.
I've already used like 3 years worth of my last vehicle,
Uh-huh.
should I buy a vehicle that's like maybe a little bit higher to like offset it from what I've
Well,
taken before?
so you had a vehicle that you've used for 3 years and you're thinking
Hmm.
about buying a new vehicle. Is that correct?
Correct.
Okay. And you depreciated 3 years of that vehicle.
Yes.
Okay. Um, so there would be recapture
Mhm.
when you trade it in, but that's not going to affect the purchase price of the new vehicle. And so I never tell anybody to spend more money than what they need on anything to get the job done, right? So my advice is to buy a vehicle that is going to work for you in the price range that you want. If you want to spend more money, and that's what you want to do, then that's great. It would give you a bigger tax deduction, right? If you're using that vehicle 80% for business, you're going to be able to take more of a deduction. But now you have a higher payment and all that fun stuff as well.
Yeah, I want to offset what I've used already, not
Yeah.
necessarily buy a more expensive vehicle.
Yeah.
I want to
So it
offset
would,
because
yeah. So
it's a bigger piece of the pie now when it starts to go into
sure,
the
sure.
especially if I buy a vehicle that's over 6,000, I can offset everything.
Yeah, you can depreciate if it's 6,000 pounds or more is what he's talking
Mhm.
about, and you used it 100% for your business.
Mhm.
Then you could take 100% deduction of that bonus depreciation we talked about, and that would offset. You could take the full purchase price of that vehicle, as well as all of the gas and oil changes and car washes and registration, insurance, all of the above, along with it, and that would offset any income or bring down your income on your business. So that would offset your taxable income. So yeah, it would definitely do that.
But I just wonder what the calculations was in regards because it's a higher piece of the pie now. I mean, it was declining on the amount that you can take over 5 years.
Uh-huh,
When now I can take 100% of it.
correct.
Yeah.
So the calculate, yeah, it's 100%. So the calculation, I'm not sure what you mean by the calculation. Like if you can take 100% of it, then if you bought a $40,000 vehicle, you take $40,000 deduction in your
I'm just
business.
saying, like I've already taken. I guess I would say
It
like
doesn't
16.
matter.
Yeah.
That doesn't matter. Yeah. What you took on that previous vehicle is only relevant in the recapture, which I think is like 25% of any remaining depreciation that you could have taken, that you got bonus for previous, right? If you took
Yes.
accelerated depreciation, it's 25% recapture rate, if I
Mhm.
remember right. And then the new car, whatever the purchase price is, you get to depreciate. It doesn't take into account the depreciation recapture or anything like that. You bought a new vehicle. If it was $50,000, that was a purchase price out the door type of thing, then you can depreciate $50,000.
I just don't want to get hit with the big giant, recapture amount where I just want to offset the whole amount.
Yeah, and yeah, that the recapture amount is going to happen,
Yeah,
right?
I understand that. Yeah, I
Yeah,
just want to minimize the impact if I
yeah.
do that.
So,
Wind up
so
doing that.
minimizing the impact is going to be using your vehicle, your new vehicle, as much as you can. If it's 100%, great. If it's 6,000 pounds or more, then you can take 100%, and that would minimize the impact. Yes.
Okay.
Yes.
I would try to get a meeting with my my rep like twice already. So I was
Uh-huh.
wondering how that works in regards to being charged.
Who is your rep?
I don't know his name offhand right now.
Offhand.
Yeah,
Okay.
but he's been on medical leave and I guess he went to surgery. So the last two accountants haven't been able to pretty much
When
answer my questions.
when is what plan are you on?
I don't know actually.
You don't know? Okay.
No.
All right. Let me do this. Boom, boom, boom. I'm going to find out. And I'll reach out to you.
Okay.
Juan Chan. What's your business name?
It's CMP charging um LLC. Rights charging.
CMP.
Yeah.
Okay. All right. I got you entered. Oh, look, you can
All
see
right.
me.
Thank you, sir.
You can see it written over there because I'm sharing the screen. Haha. Let's see. Any other questions do we have? Any other questions? And hopefully you found value in this. It's not, these are all things that we can, again, just know that they exist. That bonus depreciation, that QBI, those are very, very big deductions. They can be big deductions. And so we want to leverage those for sure for our business. And so the timing of that is critical as well, right? Because it might make sense to do it this year. It might make sense to do it next year. It might not make sense at all, So that's what I'll leave you with here is that, always think when you're spending money in your business is how is this going to help me in my business? Because a lot of people, they don't want to pay taxes, but that is not the right attitude, in my opinion, right? We want to pay taxes, we want to pay the right amount of taxes, right? I could I could have $1 million. I could make $1 million in my business, and that would be awesome. And I could have $999,999.99 and make a penny in my business, right? And so we just want to make sure that those expenses are going to some place that is going to earn us income or free up our time so that we can make money, right? That's why most of our businesses exist, right? Because somebody else doesn't want to do it. And so they pay you and they pay us to do it. And that's a great reason to spend money in a business, because now I can focus in on creating relationships with my clients or customers to make money. Or I spend money to bring in new clients, or I spend money to retain the clients that I already have, or members, customers, whatever we call them. So really think about that when you're thinking about purchasing things. You're thinking about purchasing that vehicle. I want to bring down my income, or I want to offset something. Really think about it and say, is this going to actually help, or should I just keep that vehicle for a little bit longer because it's fine? And really all it is that I just want a new vehicle. Nothing wrong with that, but right? Is it really going to help me in my business? Now, if you have a great W-2 and you have a great income, then you can have that flexibility. Like, yeah, I just want it. That's awesome to have that that flexibility to do that. I just want it, and that would be awesome. But I always think about, we don't save $1 to save 20 or 30 cents on taxes. We spend $1 to make $10, which means we will have more taxes. But that's fine, just as long as they're the right amount. So Yolanda jumped in here at the end with a question. Go ahead. You got to unmute yourself, I think.
There you go. Can you hear
There
me?
you go. I can.
Yeah, sorry, I wasn't able to listen to the whole talk. Hopefully
Uh-huh.
there's a replay, but I did have a question because
Sure.
I started doing career business with my Social Security, and I started my LLC recently.
Mhm.
So one of the companies I work for has the option where you could change it. Now I don't know if I change it now to my EIN, would it record everything I did this year under the EIN so I can have a record that the LLC is making money?
Mhm.
Or should I wait for next year because I did not keep what I used that money for? Mostly I can put it owner disbursement or something like that. I
Mhm.
could justify that way.
Mhm.
But what would you recommend? Should I wait for next year or should I change it now? And I'm not sure if it's gonna start counting from the moment I change it to my EIN or if it's gonna do my whole year. So my LLC shows that income that I have been making all year.
So you were a sole proprietor, then you became a single member LLC?
No, so I didn't have any entity made. I did my LLC this year. I was just working as an independent contractor using my Social Security number.
Okay. Which that is what a sole proprietor is just
Okay.
just using your social security number. But now you're a single member LLC now. You still own the business 100%,
Correct.
right? Yeah. So what's great about this is that I think you can decide what you want to do, because what happens is a single member LLC still files exactly the same way as you did as a sole proprietor, right? The tax consequence is the same, all of the above. The only difference is that now you have the limited liability company, so you have a little more legal protection, and you've separated your personal and business assets even further by having an LLC. But the tax consequences are exactly the same. And so what would happen is you could just put all of your income and expenses through your LLC if you wanted to. Or you could do it partly as a sole proprietor and partly as an LLC, and they just net each other out anyways on your personal return. So either way, the bottom line profit or loss will be exactly the same either way. So it just kind of
Correct.
it just kind of depends on what you're looking for. I would, for me, I would probably just start using the LLC right now.
Yeah, so I wanted to see if it was beneficial for my LLC in general for, even though I created it this year, probably like 2 months ago or 3 months ago, to have some history, right?
Sure.
Because I've been doing this job for 2 years now, but I created the LLC this year. So I wanted to see if I could leverage the 2025 1099 whenever they create it next year for tax purposes to be under the LLC and
Yep.
have the history of the full year. I'm not sure if that's going
Yep.
to happen, but I'm hoping that that's what's going to happen and at least have the full 2025 year under the LLC instead of my Social Security.
Yeah, you can do that. Because you are a single member LLC, you can do that. Yes. Yep. Because a single member LLC only files a personal tax return still, just like you did before as a independent contractor, as you said. And
Okay.
so
I
in
don't
other
have
words,
to.
the IRS will see that 1099 under the LLC, and it can match it to the 1099 that they received. And so it's accounted for in the LLC. And so there's not anything
Okay.
that you really need to do any extra. We do that all the time. We put it underneath the LLC, even if it was written out to your Social Security number.
So even if it's under my security number, you could put it under the EIN?
Yep. Yep.
Oh, that's good to know.
Yep. And in fact, just to go into a little bit deeper, we got 1 minute left. The IRS considers you a disregarded entity. And all that means is they don't see your LLC and you as any different, because 100% of your money is going to you personally, right, in your business, whether you are a independent contractor or an LLC. It goes on the exact same form, Schedule C, on your personal return. And so they just say, we don't see any difference because there's only one of you. You're not a multi-member LLC. And so you can put that 1099 that you're going to get next year on your LLC because they don't see you as any different. But you still have the legal protection now of an LLC. That's why an LLC is great, is because of the legal protection, not because of any tax benefits. Tax benefits are the same. All right. I think that will wrap it up for us. Great questions, everybody. If you still have questions, reach out to your tax accountant. If it's about taxes, if it's about bookkeeping, reach out to your bookkeeper, your guide. But other than that, everybody have a great rest of your day. Bye, everyone.